Imagine a warehouse stacked high with boxes and a business owner looking puzzled. Have you ever wondered how much your inventory is really worth? Getting this number right is crucial, because if you miscalculate, your profits, your assets, and even your taxes could all be off. That's why today we're diving into IAS 2, the accounting standard that helps businesses value their inventory correctly. Don't worry, we'll break it down step by step so by the end you'll feel confident about how inventory impacts your financial statements. Let's get started and see why mastering IAS 2 is essential for every business owner. IAS 2 is an important accounting standard that guides companies on how to value and report their inventory. Picture an official accounting book opening up with the word inventories highlighted. IAS 2 answers four key questions: what counts as inventory, how should inventory be measured, when should inventory be written down, and what must be disclosed in the financial statements. In short, IAS 2 ensures that inventory isn't overstated, which protects the accuracy of a company's reported profits and assets. Understanding these basics sets the stage for applying the rules correctly in real business scenarios. Let's break down what IAS 2 considers as inventory. Imagine three boxes, each labeled differently. The first box is finished goods, these are products ready for sale sitting on the shelf. The second box is work in progress, these are items still being manufactured, not quite ready yet. The third box is raw materials, these are the basic materials waiting to be used in production. It's important to note that inventory does not include financial instruments or biological assets, which are covered by other standards. By knowing exactly what counts as inventory, businesses can apply IAS 2 correctly and avoid costly mistakes. Now let's talk about the core principle of IAS 2, how to measure inventory. The golden rule is simple: inventory should be recorded at the lower of cost and net realizable value, or NRV. NRV means the estimated selling price minus any costs needed to finish and sell the goods. For example, if your inventory cost is $100, but you can only sell it for $90 after expenses, you must record it at $90. This rule prevents companies from overstating their assets and ensures financial statements reflect reality. Remember, always choose the lower number between cost and NRV when valuing inventory. Finally, let's look at what makes up the cost of inventory under IAS 2. Imagine three buckets being filled with money. The first bucket is for the cost of purchasing inventory. This includes the price paid to suppliers, plus any import duties and transport costs. The second bucket covers the cost of converting raw materials into finished goods, such as labor and manufacturing overheads. The third bucket is for other costs necessary to bring inventory to its present location and condition. By understanding what costs to include, businesses can ensure their inventory values are accurate and compliant with IAS 2.